This is not a warning. This is not clickbait. This is a financial emergency unfolding in real time. And if you are holding silver, if you're thinking about silver, or if you simply care about where your wealth is going, stop everything you're doing right now and pay attention. Before we look at a single price chart, before we talk about margin calls or futures contracts or what JP Morgan is doing behind closed doors, I need you to do one thing. Open your banking app. Look at that number sitting next to your name. Now ask yourself, is that number growing faster than the rate at which money is being printed? Because if it is not, your wealth is quietly disappearing, not in a dramatic crash, not in a sudden collapse, but slowly, silently, while you sleep. And if you think gold or silver prices are just going to drift along calmly this year, I have news for you. What is happening right now in the silver market is not a drill. It is a mathematical pressure cooker that has been building for years and the valve is about to blow. Let me tell you exactly what is happening. Today is Sunday, February 15th, 2026. And as of this moment, we are entering one of the most dangerous and potentially explosive trading windows in the entire modern history of silver. Not gold, not oil, silver, the metal that sits at the center of every solar panel, every electric vehicle, every advanced circuit board on the planet, the metal that the world cannot function without, and the metal that is about to experience a supply shock unlike anything we have seen in decades. Here is what you need to understand. Starting today, the Chinese financial markets are shutting down for the Chinese New Year holiday. 9 consecutive days of silence. 9 days where the gatekeepers of 60 to 70% of the world's refined silver supply go completely dark. And while China sleeps, the Western paper market, the COMEX exchange in New York, the banks in Chicago, the hedge funds on Wall Street, they are wide awake and they are hungry. Let us talk numbers because numbers do not lie. Silver today is trading at approximately $32 to $33 per ounce in the Western spot market. But here's where it gets interesting. In Shanghai, silver has been trading at a premium of $15 to $20 per ounce above Western prices. That is a 25% spread between East and West. In normal market conditions, a 1% arbitrage spread is considered significant. A 25% spread is not a market inefficiency. It is a signal. It is the market screaming at you that something is fundamentally broken in the supply chain. Gold, meanwhile, is pushing above $2,900 per ounce. People are starting to pay attention to gold. But the real story, the story that most financial media is completely ignoring, is silver. Now let us go back to the 9-day window. When China goes dark, something very specific happens in the silver futures market. The largest physical buyer of silver on the planet goes offline. The counterweight that has been holding the price steady disappears. And the institutions that are massively short silver, meaning they have sold promises to deliver silver they do not actually have, they see their window of opportunity open wide. We are talking about COMEX, the commodities exchange in New York, and its largest participant, JP Morgan. And here is a number that should make you stop breathing for a moment. The registered silver inventory at COMEX, that is the silver actually available and tagged for delivery on futures contracts, currently sits at approximately 100 million ounces. 100 million ounces sounds like a large number until you look at the other side of the ledger. The open interest on COMEX silver, the total number of outstanding paper contracts that represent promises to deliver silver, represents approximately 400 million ounces. Let that sink in for a moment. They have written promises to deliver 400 million ounces of silver. They have 100 million ounces available. They have sold 4 times more silver than they actually possess. This is not a conspiracy theory. This is not speculation from some internet forum. This is publicly available data. You can go to the COMEX website right now and pull these numbers yourself. They have sold you a car 4 times over and promised to deliver it next week. Now here is where it gets even more alarming. February 27th is the delivery deadline for March silver contracts. That is 13 days from today, 13 days before the exchange must start answering a very uncomfortable question. Can they actually deliver the metal, or does the system break, and the battlefield is already being drawn? On one side, you have China. The Chinese Communist Party controls between 60 and 70% of the world's refined silver supply. Not mined silver, refined silver. The bars that actually move through global markets. They import raw ore from Mexico, from Peru, from all over the world, refine it in their industrial smelters, and then, until very recently, they decided where it went. Apple needed silver for circuit boards. They got it. Tesla needed silver for solar panels. They got it. And when the COMEX needed physical metal to cover their short positions and suppress the price, they got it too. China was the pressure release valve that kept the Western paper casino running. But on January 1st, 2026, China flipped a switch. They implemented a new export licensing system for silver. And under this system, only 44 companies in the entire country of 1.4 billion people are now authorized to export refined silver. 44 companies. In a nation that controls the global supply chain for one of the most critical industrial metals on Earth. This is not a regulatory adjustment. This is not paperwork. This is a strategic chokehold on the global silver supply, and it happened 6 weeks ago. Now, let us talk about what this export restriction actually means in practical terms, because most people hear export licensing and think bureaucracy, think paperwork, think minor inconvenience. No. What China has done is the equivalent of OPEC announcing that only 4 refineries in all of Saudi Arabia are allowed to ship oil to the West. It is a structural cutoff, and the effects are already showing up in the numbers. If you're a silver refiner sitting inside China right now, you have a very simple choice. You can sell your refined bar to a buyer in New York at the current Western spot price, roughly $32 per ounce. Or you can sell it domestically inside China, where solar panel manufacturers are desperate for metal, where electric vehicle production lines are running 24 hours a day, and where domestic demand is so intense that premiums of $15 to $20 above the Western price are being offered without hesitation. Who do you sell to? You sell domestically, every single time. The metal stops leaving China, the West gets cut off, and the price differential between Shanghai and New York begins to widen into a canyon. Now, some of you might be thinking, but silver is a globally traded commodity. If Shanghai prices are 25% higher than New York prices, arbitrage traders would flood the market and close that gap instantly. That is how efficient markets work, right? Wrong. Markets are efficient when information flows freely and when physical delivery is frictionless. But when one nation controls the refining capacity and simultaneously implements export restrictions, the market fractures. You cannot arbitrage a bar of silver that is not allowed to leave the country. The gap does not close. It widens. And right now, that gap is sitting at a level that, in normal conditions, would be considered a financial black hole. So why is China doing this? The answer is brutally simple. They own the metal. And when you own an asset, you want its price to rise. China is not just restricting exports to cause chaos. They are restricting exports because they need the silver themselves. They are installing 160 gigawatts of solar capacity in 2026 alone. 160 gigawatts. Every single gigawatt of solar capacity requires thousands of ounces of silver paste for photovoltaic conductivity. Scale that to 160 gigawatts, and you're talking about tens of millions of ounces of silver consumed domestically in a single year, just for solar panels, not jewelry, not coins, not investment bars. Industrial consumption that permanently removes the metal from the global market. That silver gets embedded in a solar panel on a rooftop in Shenzhen, and it never comes back. Now add electric vehicles. China is not just building EVs for domestic use. They are flooding global markets, undercutting Western manufacturers on price, and every EV contains silver in the battery management systems, in the charging components, in the electronics. Multiply that by millions of units per year, and you are looking at another massive and permanent drain on global silver supply. This is not speculative demand. This is not investment demand that reverses when sentiment changes. This is industrial consumption growing exponentially with no ceiling in sight. And on the other side of this trade, you have COMEX and JP Morgan. They are short, massively short, the kind of short position that makes your stomach turn when you actually look at the math. Let me show you exactly how short they are. The registered silver inventory at COMEX, the metal with a for sale sign on it, available for immediate delivery to anyone holding a futures contract who stands for delivery, sits at approximately 100 million ounces. Now, the total silver sitting in COMEX vaults, including what they call eligible silver, is closer to 300 million ounces. But eligible silver is not available for delivery. It belongs to private owners who are storing it in the vault but have not authorized it to be sold. Think of it like a parking garage. Some of the cars are for sale. Most of them are just parked. The exchange cannot touch the parked cars. So the real number, the silver they can actually deliver right now, is 100 million ounces. Against 400 million ounces of paper promises outstanding. Now here is where January becomes a very important data point. January is historically the quietest month for silver deliveries on COMEX. A slow month, a nothing month. The typical delivery volume is around 7 million ounces. Routine, predictable, boring. This January, nearly 50 million ounces were delivered, 7 times the normal amount. Contract holders are no longer rolling their positions forward. They are standing for delivery. They want the physical bars in their hands. Not paper, not promises, not a statement on a screen. They want the actual metal. And COMEX is hemorrhaging inventory trying to meet that demand. The vaults are draining. China has cut off the resupply line. And February 27th, the delivery deadline for March contracts, is 13 days away. So what does JP Morgan do? What does COMEX do when the vaults are emptying, the resupply is gone, and physical demand is at historic levels? They have exactly 2 options. Option 1, admit defeat, let the silver price run, Cover their short positions at a catastrophic loss. Face the reality that they sold metal they never had and pay the consequences. Option 2, fight back. Use the 9-day Chinese holiday window to attack the paper market, crush the price by force, and buy themselves time. History tells us exactly which option they choose. They choose option 2. Every single time. Without exception. Without hesitation. And if you think that is an exaggeration, if you think that regulated financial institutions operating in the most sophisticated markets on Earth would never deliberately manipulate prices, then let me walk you through some recent history that is not ancient, not theoretical, and not disputed. In 2020, JP Morgan was ordered to pay $920 million in fines for manipulating precious metals markets. Not alleged manipulation, proven manipulation. The Department of Justice investigated, prosecuted, and won. JP Morgan traders were caught using a strategy called spoofing, placing massive fake orders on the COMEX to move prices in a specific direction, then canceling those orders before execution. They did this hundreds of times, across years, in gold and silver markets simultaneously. The Department of Justice called it a massive fraudulent scheme. These are not my words. These are court records, public documents. This happened 6 years ago. So when I tell you that JP Morgan and COMEX have both the incentive and the documented history of manipulating silver prices, I am not speculating. I am citing federal court records. And starting today, starting this 9-day window, they have their best opportunity in months to execute that exact playbook again. Here is how the attack works. And I want you to understand this mechanics clearly because it is going to explain every price movement you see over the next 9 days. Step 1. They flood the paper market with short contracts, not physical silver, paper promises. They dump massive sell orders into the futures market, artificially pushing the price down. Because in the paper market, you can sell silver you do not own. You can sell silver that does not exist. You simply need enough capital and enough institutional credibility to place the order. Step 2. They raise margin requirements for long positions. When you are holding a long silver futures contract and the exchange suddenly raises the margin requirement, you are forced to either deposit more cash immediately or liquidate your position. Most retail traders and smaller funds cannot meet sudden margin calls. They are forced to sell, and that forced selling adds more downward pressure on the price, which is exactly what the short sellers want. Step 3, they coordinate the narrative. Across financial media, across analyst reports, across the mainstream channels that most investors trust, you begin to hear the same message. Silver is overvalued. Silver is illiquid. Silver is about to correct sharply. The psychological warfare begins. Fear enters the market. Weak hands start selling. And they do all of this while China, the one counterforce large enough to absorb the selling pressure and defend the price with physical buying, is completely offline. We have seen this exact playbook executed before. In 1980, the Hunt brothers from Texas accumulated a silver position so large that they effectively controlled half of the world's tradable silver supply. The price ran from $6 per ounce to $50 per ounce in a matter of months. The COMEX directors panicked. These were the same people running the exchange who also happened to be short silver. The people running the casino were the ones losing money at the tables. So on January 7th, 1980, they did what any person who owns the casino and is losing would do. They changed the rules. They implemented Silver Rule number 7, which stated that starting immediately, you could no longer buy silver futures on margin. If you wanted to purchase a contract, you had to put up 100% cash, full payment upfront. No leverage allowed, but here is the critical detail that most people miss when they tell this story. The rule only applied to buyers, long positions. If you were short silver, if you were on the selling side, you could still use margin, you could still use leverage. The buying pressure was completely choked off while the selling pressure was left fully intact. The price collapsed from $50 per ounce to $11 per ounce in a matter of weeks. The Hunt brothers could not meet their margin calls. They were forced to liquidate at catastrophic losses. They were bankrupted. And for good measure, the government then sued them for market manipulation. The very exchange that had changed its own rules mid-game to destroy them turned around and pointed the finger. The Hunt brothers lost everything. Meanwhile, the banks and the COMEX directors who had been short the entire time walked away without a scratch. Now here's the critical difference between 1980 and today. In 1980, the exchange was fighting two billionaire brothers from Texas. In 2011, when silver last approached $50 per ounce, they were fighting retail investors buying coins and bars from local dealers. Individual people with personal savings, easy to frighten, easy to shake out. But today is different. Today, they are not fighting individual investors. They are not fighting a pair of wealthy brothers. Today, COMEX and JP Morgan are standing across the battlefield from the second largest economy on the planet. They are facing a nation with nuclear weapons, a $19 trillion GDP, absolute control over the global silver refining supply chain, and a government that has made the acquisition and retention of physical precious metals a matter of explicit national strategy. This is not David versus Goliath. This is Goliath versus Godzilla. And China knows the attack is coming. They are not naive. In the last 72 hours before going offline, the Shanghai Futures Exchange implemented new restrictions on short selling. They raised margin requirements specifically for short positions, the exact opposite of what COMEX did in 1980. They are building a fortress around their domestic silver market before the holiday begins. They are making it expensive and difficult for Western hedge funds and foreign banks to use Chinese exchanges to suppress the price while China cannot respond. The two largest financial systems on Earth are now playing chess with silver as the board. So where does this leave you? Where does the individual investor stand when two economic superpowers are locked in a battle over the most industrially critical metal on the planet? Let me break this down as clearly and as honestly as I possibly can, because what happens over the next 9 days will determine the trajectory of silver prices for the rest of 2026. Let us start with the math that nobody in mainstream financial media wants to discuss openly. Silver right now is trading at approximately $32 to $33 per ounce in the Western spot market. Gold is pushing $2,900 per ounce and climbing. The gold to silver ratio, the number of ounces of silver it takes to buy 1 ounce of gold, currently sits at approximately 88 to 1. Historically, over centuries of monetary history, that ratio has averaged between 15 and 30 to 1. At the current gold price of $2,900, a historically normal ratio of 30 to 1 would place silver at nearly $97 per ounce. At a ratio of 15 to 1, which is closer to the actual geological abundance ratio of silver to gold in the Earth's crust, silver would be trading at nearly $200 per ounce. I'm not telling you silver is going to $200 tomorrow. I'm telling you that the structural undervaluation of silver relative to gold is one of the most extreme in recorded financial history. And that kind of extreme divergence does not last forever. Now add the supply shock. China controls 60 to 70% of refined silver supply and has just restricted exports to 44 authorized companies. The COMEX has 400 million ounces of paper promises, outstanding against 100 million ounces of registered physical inventory. January deliveries just came in at 7 times the historical average. The Shanghai premium over Western prices is sitting at 25%, a spread that screams physical shortage. And in 13 days, the March delivery deadline arrives. Every single one of these data points is pointing in the same direction. The physical market is tightening at a pace that the paper market is not reflecting yet. Now let us talk about what happens during this 9-day window and how you should interpret every price movement you see. If silver drops sharply over the next 9 days, if you wake up Tuesday morning and the price has fallen $2, $3, or $4 per ounce, do not panic. Understand what you are looking at. You are looking at the paper market being attacked. You are looking at short contracts being dumped, margin calls being triggered, and financial media running coordinated narratives about silver weakness. This is the playbook. This is option 2 being executed exactly as it has been executed before. The question is not whether they can push the paper price down temporarily. They can. They have the institutional size, the market access, and the regulatory relationships to move the paper price in the short term. The question is whether that paper price suppression can survive contact with the physical reality of the market. And the physical reality is this: the metal is not there. The vaults are draining. China is not resupplying. Industrial demand is permanent and growing, and the delivery deadline on February 27th does not move. You cannot settle a physical delivery obligation with a paper contract. At some point, the exchange must either produce the metal or admit publicly that the system is broken. And that moment, that admission, is what the silver market has been building toward for years. Now let us talk about gold for a moment, because gold tells an important part of this story. Gold at $2,900 is not just an investment story. It is a signal. Central banks around the world have been buying gold at record levels for 3 consecutive years. China, Russia, India, Poland, Turkey. Sovereign governments are moving away from dollar-denominated reserves and into physical gold at a pace that has no modern precedent. When central banks buy gold, they are not making a trade. They are making a statement about where they believe the global monetary system is heading. And silver follows gold. It always has. But silver moves faster, harder, and further in both directions because the market is smaller and the industrial demand component adds a layer of urgency that gold does not have. Gold sits in vaults. Silver gets consumed. Silver gets embedded in solar panels and electric vehicles and circuit boards, and it does not come back. Every ounce consumed industrially is permanently removed from the investable supply forever. Charlie Munger used to say, "Show me the incentive and I will show you the outcome." So let us look at the incentives one final time. China's incentive, make silver expensive. They own the supply. They need the metal domestically. A higher price benefits them on every level. COMEX and JP Morgan's incentive: suppress the price temporarily, shake out weak hands, reduce their short exposure before the delivery deadline crushes them. Physical silver holders: incentive, hold, do not panic sell into manufactured weakness. Understand that the paper price and the physical reality are diverging in real time. The 9-day window opens today. The delivery deadline is 13 days away. The vaults are draining. China is offline. And the most important battle in modern silver market history is being fought right now. While most investors are watching something else entirely, the measuring stick is breaking. And when a measuring stick breaks, everything it was measuring looks different. Gold and silver are not going up. The dollar is going down. And the 9 days ahead will tell us exactly how much further it has left to fall. Pay attention. The window is open, and it will not stay open for long.